Welcome to the Kenorland Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Kenorland Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey Fleck here, your host for this weekend's edition. Chad is taking a little time to visit with family, so just going to be me carrying this show, and we're going to be very much focused on the precious metals segment as I have a new guest on the show, which I'm very excited to kick off the show with. And on the back end of the show, we're going to hear from a fund manager focused in the metals sector. We're going to be talking market cycles for precious metals and also the pecking order in terms of large companies and money, how it's filtering down to some of the smaller companies. But again, still a very different environment for a lot of those juniors. So to kick off the show, very excited to announce that I am chatting with Randy Smallwood, President and CEO of Wheaton Precious Metals, also the past chair of the World Gold Council. Still very actively involved with the World Gold Council, and we'll tie that into some more of the comments around the precious metal sector and how it's working to get in front of new shareholders. So Randy, thank you very much for joining me. Let's start off by talking about your overall assessment of the precious metals market here. What sort of cycle are we in when you consider gold technically bottomed about 9 years ago? 2016, right around $1,000 an ounce. It's been moving higher ever since. And this year, especially in March, had some pretty significant breakouts and has very much established itself above $2,000 an ounce. So, Randy, your assessment of the cycle that we're in for precious metals, please.
Well, first off, Corey, a real honor to be on the show with you, and thank you so much for the invite. It's actually a really interesting gold market right now. I've got enough what I call silver hair in me to remember that gold has actually been on a pretty strong bull run with a lot of volatility, or some periods of volatility, for over 20 years now. I do remember gold as low as $265 an ounce and having to make a living in this industry at $265 an ounce. And so yes, we're definitely on a good bull run, but there's a lot of strength in this market. And what's really unique about the last few years is that I would say this latest surge in gold prices is one that doesn't really fit with past bull markets, in the sense that we've got a strong US dollar and strong gold prices, and that is very rare. Usually strong gold comes with a weak US dollar, and vice versa, of course. And so what I would say is that what we're dealing with right now over the last couple of years, and what's really taken gold up to the record levels that we're seeing here in the last couple of months, is a real strong momentum that started in the eastern part of the world. China, Southeast Asia, the Middle East, even Eastern Europe, just really sort of kickstarted with both retail investing. I think there was a big segment of the Chinese middle class that got nervous about their store of value in real estate. And so there was a real push in China with respect to replacing some of their stored value in real estate with gold reserves. But central bank purchasing also out of many countries around the world, China almost leading the way, but good strong purchases from Turkey, from Singapore, from Poland. India has been positioning itself, all sorts of support all the way across the board from that perspective. And so what we haven't seen, though, is good, strong equity support here in the Western markets. And in fact, I would also say that, up until recently, we weren't seeing good measures of support at the ETF level. So it was a unique market in the sense that here we are with really strong commodity prices. Gold is climbing, and yet the equities aren't being supported, and ETF holdings for the longest time were actually dropping. That's changed. We're starting to see a bit more of an appetite, and definitely the senior companies in the gold space are starting to get a little bit more support. We're still not seeing that level of support at the junior level. ETF holdings have been clawing their way back. They're nowhere near where they were at record, in terms of their record highs, which is, surprising considering that we're dealing with gold prices that are near record highs, which just tells me how much more strength there is. The West really hasn't woken up to gold yet, totally. But we still have good, strong support. I've seen China now has started, again, buying major gold for its central bank. And so we've still got good, strong support for gold around the rest of the world. But the West is well on its way to waking up. And I think the combination is pretty exciting for where we think gold prices will be going.
Yeah, it's been that story. Hey, gold's doing its job, but the equities just not providing that leverage that most investors want from them. And that always brings up the question. We get that question so much. What's it going to take to get other investors into the sector? Because it very much feels like we're just trading amongst ourselves, the diehard gold bugs and the metals investors that have been in this sector during the bear markets, still around now. I think it all comes down to the majors. Look, we can look to juniors and say you guys need to perform better, but quite frankly, we know the trend of investors coming into larger cap companies and then filtering down. The majors, it's been a real mixed bag. Still having a little trouble controlling costs, and their ability to grow is very much hampered because it takes a while to bring mines into production. How do you see the environment for majors? What more can majors do here?
Well, talk is cheap, Corey. Talk is
Yep.
cheap. We need to deliver as an industry. We need to deliver better results. And that's what brings in more investors and stronger investment support and people taking their profits from their gold investments and reinvesting it back into other opportunities. We need to actually deliver, though. We need to deliver those stories. And I'm going to say that one of the challenges that we do face as an industry, and it's not just the gold industry, it's actually the entire resource industry, is that it's cost measures, it's cost controls, and delivering on those cost promises. And the challenge that an industry faces as a whole, especially the mining industry, it's one of the reasons why we created the streaming business model that Wheaton has. Because in the mining industry, costs will chase the commodity price because when commodity prices climb and you sit and think about gold, and as you mentioned, back 9 years ago, gold was down close to $1,000 an ounce. We're now well over $2,600 an ounce with a good firm foundation beneath it and all the vectors pointing to higher prices. And ore bodies change when you see that much of an increase in commodity price. And the challenge, of course, in the mining industry is that as prices climb, as the commodity price climbs, the way I describe it is high grade waste becomes low grade ore. And it means that the mining companies, the operating companies have to chase, rock that has less metal in it because it's now profitable with these higher prices. And that will drive up costs. And that's always been one of the challenges. The expectations, the hopes of shareholders is that mining companies hold their costs constant and you deliver that return or that increase in commodity prices, that gain right back to the shareholders. But the reality is, in a general sense, there's all sorts of unique individual stories, but in a general sense, the industry suffers from higher costs whenever commodity prices climb because you wind up having to chase lower grade material to push it through. And all of that lower grade material comes at a higher cost on a per ounce or a per pound basis, no matter, irrespective of what material you're talking about. As I said at the start of this, that's one of the huge advantages of the streaming business model is that our costs are actually defined on a per ounce basis. Both the capital cost, which is our upfront payment to get into the streaming contracts, but then also the production payment, the cost per ounce that we get when metal is delivered. This is all defined by contract. And just taking that cost risk out has finally given shareholders a way to actually seriously invest into the industry and get the benefit of higher commodity prices.
Yeah, look, that streaming model, so much better of a business model because it does protect you against major cost overruns and individual mine risk. But from the, I guess, royalty streaming aspect, are you seeing more opportunities in some of these smaller companies or mid-tier miners that do seem to have a little bit better control of their costs?
Well, Corey, our business is delivering capital to the mining industry, and at different periods of the cycle, sometimes it's the majors that need that capital. Sometimes it's the mid-tiers that need that capital. Sometimes it's the juniors that need that capital. I would describe today's market as the juniors are definitely the little single asset or maybe a two asset junior companies trying to build mines. They're the ones that need the most support. They're the ones that aren't getting the support from the equity markets, and therefore streaming as a source of financing, as a source of capital for them is incredibly competitive, incredibly attractive. When you're trying to build a mining company and you're trying to finance this through equity and your shares are trading at 0.3, 0.4 times net asset value, and you can do a stream at close to 1 times net asset value, you know which is going to win that argument. The CFOs of every mid-tier and junior company out there are very friendly with all us streaming companies right now. So that's been where we've been very busy. We haven't seen a lot of the majors. If you're operating right now with, especially in the gold space, with the margins that you have, you're pretty well cash flow positive. You're generating good returns, and you shouldn't have any problem in terms of doing that. But we are very busy on the mid-tier and junior side. A lot of single asset developers knocking on our door.
Oh, I bet they are. That's one thing I wanted to touch on, is it does seem like some of the more recent investments from Wheaton have been in more of the junior companies. Are you willing to take a little bit more risk then going down into some of these earlier life assets that maybe have a longer runway to becoming cash flow to you because you see the opportunity of being, in a way, almost the last source of capital for some of these companies?
Well, if we're the last source of capital for the company, we probably shouldn't be there. We're always focused on assets that should be producing in the bottom half of the respective cost quartiles. So that's to say that if I'm looking for a purchase, a streaming agreement for gold from a copper mine, because just about every copper mine in the world produces a bit of byproduct gold. And actually, more than 60% of our gold comes from copper mines. And so if I'm looking for that, one of the first tests that we have is where does this copper mine fit on the worldwide copper cost curve? Because if our partners aren't profitable, we're not profitable. So if the partners are going to be profitable, there will always be a measure of support for these companies in terms of bringing these projects forward. So, if we're the only source of capital, then we probably shouldn't be investing into that asset. We're really selective about what we invest in. We at Wheaton have had great success on that front. And so, it's just it's a matter of being selective. And then when we make our investments, they are risk adjusted. And so if we're in riskier jurisdictions, if we've got challenging, if it's a single asset company, if it's a country that's got higher political risk levels to it, if the resource upside isn't as strong, metallurgical factors, stuff like this, development projects versus operating projects, all of those feed into what kind of a return we expect on our investment. And so we've got about 20 different factors that sort of capture that risk. And, I think we've done a pretty good job of that in terms of, it doesn't take much to see that when we're, some of the assets that we've invested into in riskier jurisdictions, we get a better rate of return on those investments. And the one thing, Corey, that I just need to remind you is that some of these assets, especially the early stage ones, the development ones, there's incredible upside to them from an exploration perspective, from expansion. One of the things that we always find, we like investing into copper assets because there's usually very little focus put on gold recovery. And it does tend to do better when it comes to them making the feasibility studies and such like that. There hasn't been a lot of focus on improving gold, and we do see improvements once they bring these things up. And so there is some real hidden opportunities in some of these smaller single asset companies.
Now, you talked about kind of the geographic diversity that you have and some of the better returns coming from what are perceived as sketchier jurisdictions. What sort of risk are you willing to take regarding jurisdictions? Because boy, oh boy, all we're hearing about this whole last year was permitting, how companies can advance with permitting, and all the delays that inevitably come with permitting.
Well, to be honest, I mean, one of the other protections that we have is that the large portion of our capital doesn't go into the ground until permits have been received. So we'll set up these streaming agreements, but one of the first things that has to be satisfied is permits received because our money goes into the construction capital. So that is one of the key aspects of it. But when it comes to jurisdictions, there are definitely uninvestable jurisdictions in this world. We won't touch China. We won't touch Russia. We need to be in jurisdictions where we feel like we would get, if it ever came to going to court, we never have had to. But in our eyes, it needs to be a jurisdiction where you can be confident of fair representation in the courts of that land. And so, there are ways we can temper that risk. We are a company that uses parent guarantees. And that's a really important aspect in terms of controlling risk, as some of our peers have discovered. It is something that does give a lot of confidence to us in that if something goes wrong within a particular operation, at least we have a parent guarantee that allows us to protect our shareholders' interests by looking at the broader assets of the company that's operating this mine. And that's an incredibly important. I mean, one of the things that we at Wheaton really put a lot of focus on is structure that protects our shareholders in the event of. We're happy to take geological risk, to take the operational metallurgical risk and such like that. But when it comes to political risk, we think that's best left in the hands of the operator, not the streamer. And in fact, I would argue that I've had to remind many a company that we are in the business of streaming gold and silver. We are not in the business of streaming political risk. And so you keep that in your hand, give us a parent guarantee so that in the event something goes wrong, we'll get our money back.
Yeah, very interesting. Well, nice position to be in too. But hey, look, there is always that political risk. You mentioned one thing here about recovery, sometimes looking at a copper mine and taking the gold stream out of it because people don't sometimes pay that much attention to some of these other, in a way, byproducts to major mines. Are there any technology advancements that you're seeing in this sector that you can encourage companies to use that would, in a way, just improve overall economics, but also just help us mine a little bit more efficiently?
Well, constantly. And to be honest, we have a program at Wheaton, which we call sort of a technical ambassador program, where we're constantly, I mean, the advantage that we have at Wheaton is that we visit every single one of our assets at least once a year, especially the operating assets. But we also look at a lot of other opportunities out there, which gives our technical teams a really good sense of best practices and I would say at the other end of the spectrum, worst practices. And so we're always willing to share and try and keep our partners as well informed as possible about the best of technologies. We've actually just kicked off a Future of Mining challenge, and it's really, again, about improving efficiencies and minimizing impact. And it's $1 million US prize that we're going to be awarding at the PDAC next year in Toronto. And we announced it during the Denver Gold Show in September of last, or I guess earlier this year, it's still December. And we've had huge interest levels from this, well over 30 applications. We've now received them, we're going through them, and one of those companies is going to be, $1 million richer towards advancing their technology of trying to improve operational efficiencies on a go-forward basis. And so it's something that the whole industry needs. At Wheaton, we're very focused. We do have an overlying mantra in our company, which is that the stronger our partners are, the stronger we are. And so we owe it to all of our stakeholders, to do the best to help our partners be strong. And I think it's one of the things that makes Wheaton unique as a partner of choice. And we have so many repeat customers in terms of people that have worked with us in the past coming back to us. And it's all really a part of, or a result of all the effort that we put into trying to make sure we continue to deliver good, solid value and supporting our partners in delivering the best technologies.
Hey, kudos to you, Randy. I think this sector needs even more of that collaborative effort. And that even ties into the World Gold Council, too. But also what Wheaton is doing. What, in your eyes, can these large companies or even the World Gold Council do to further support the sector that could also result in more investors coming in?
Well, one of the challenges, I look at the gold sector and I do find it interesting that there's such high levels of interest, but there is a challenge. There's a trust challenge that we have to get to. And here's a little sidebar. I think we've all heard about Costco finally bringing in gold and selling, gold bullion in their Costco stores, and it's selling out incredibly rapidly. They can't keep it stocked every time they bring it in. And it's actually now becoming a pretty significant, it actually gets a separate revenue line in Costco's financial statements now. Costco is one of the most trusted retailers in the world, definitely in North America, in their world, wherever they operate. They are one of the most trusted. And so there's a lesson to be learned there about the trust behind the product that we're delivering. And so we at the World Gold Council have kicked off a huge number of initiatives towards elevating that trust. We've got a gold bar integrity program that a lot of the members, if not all of the members, very close to all of the members have now committed to, where we're now, detailing and reporting provenance behind the gold that we send off to the refineries. And the refineries themselves have also committed to this. And so what that will allow is investors to know exactly where their gold has come from and know the positive benefits, that gold production, where it was mined, and the positive benefits that were associated with that production. And so, I really do think it's elevating the trust from the investing space that the industry as a whole needs to do. The confidence of knowing that, you're not dealing with sort of dirty gold, for lack of a better phrase around it, and that you've got that clear provenance and that clear conscience behind the gold that you're investing into it. I saw recently Newmont is now committed to be the main supplier of all of the gold at the Costco retail things. Again, that high level of confidence and trust is only going to help in terms of attracting investors. And we just need to make it easier and more trustworthy to invest into gold. And that change is coming.
Randy, it's great having you on the show. Look, I really appreciate you taking this time to more talk big picture about the market. I think it's fascinating to hear from someone in your shoes how you're viewing the market and also how you're positioning Wheaton with continuing to support, but then also make money for shareholders. I'll open up the floor to you, though. Just give us a quick overview of Wheaton, the growth profile that you want investors to note as we head into the new year. And I know you have a long growth profile, so take us through the key selling features.
Well, we've just finished our 20th year, or we're in our 20th year of existence. We started the streaming business model in October of 2004, and so we celebrated a couple of months ago. And the company hasn't been in a better spot than where it is right now. This year we're on track to produce somewhere close to 600,000 gold equivalent ounces, a little bit in the higher end of our guidance that we gave earlier in the year. But what's really most exciting about where we are right now is the growth profile we have on a go-forward basis. Now, keep in mind that, because we're a streaming company, we can give you cost confidence. The ounces in our company will not ever cost more than $500 an ounce. They're all in the 450. Each one of our contracts has a unique production payment associated to it, but on average, we're about $450 per ounce, which is good because it gives us a bit of leverage over bullion and, for that matter, royalty companies that have become streaming companies, because we are a pure streaming company. All of our production comes through streams, and so we do have a bit of leverage. Obviously, not as much leverage as the producers, but that, as we know and I've already talked about, comes with a much higher level of risk, especially on the cost front. So the growth that we've got over the next, 5 or 6 years now, and in fact, we've got continuous growth every probably 7 years out. We're on a path to 1 million gold equivalent ounces. We've added some significant streams this year. We've completed 10 transactions in the last 2 years, but the most recent one with Montage Gold on the Koné project in Côte d'Ivoire in Western Africa. It's going to add close to 10% of about 8% actually of our total production. So it's going to grow that even over and above. And so really what we're starting on is starting next year in 2025, we have 4 new mines coming into production. And we're going to be growing on average about 10% per year for the next 5 to 6 years. So, we're in an enviable position of every quarter probably being a record, and from a production perspective. And of course, with the trend in commodity prices, that just bodes well. If we continue to see higher and higher gold prices, and there's definitely strong momentum in that direction, that combined with our growth makes us, without sounding boastful, it's one of the most attractive ways to invest into the precious metal space. And the one aspect that I'm really sort of happy about, and I've seen this in some of my recent marketing. I just spent a better part of 3 weeks touring Europe, meeting with investors. I spent a lot of time in the East Coast. We're based here in Vancouver, but spent a lot of time in the East Coast of the US and Eastern Canada. The one aspect is that we are seeing more and more generalist interest in the industry. And I got to say, there's no better way for someone to dip their toe into the precious metal space than to come into a streaming company, because we really deliver you the best of the mining company in our life of mine agreements, where we give exploration and expansion potential and upside and commodity price exposure. But we do it in such a low risk way without the cost surprises that have made so many mining investments bad investments. We don't have any cost surprises in our company. We're very, very predictable on the cost side. And so I think we're perfectly positioned to really be a leader through the continued strong momentum of gold prices. That, with our growth, and makes us, as I said at the start of this answer, the strongest position we've ever been in at Wheaton, and very exciting times.
Yeah, well, look at the share price too. The market has taken notice, which is nice to see, because as much as we've seen a real dichotomy of some stocks doing well, Wheaton has been one that has continued to perform quite nicely. Again, Randy Smallwood, President and CEO of Wheaton Precious Metals. The company is traded WPM on the TSX, NYSE, and the London Exchange. Randy, thank you very much for your time. Pleasure having you on the show.
Corey, thank you. I really enjoyed that.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. All right, welcome back. Continuing to listen to the KE Report Weekend
show. I hope everybody enjoyed that first half of the show with Randy Smallwood, really focusing on big picture themes from a major company and a company that provides capital to a lot of more advanced stage companies. But hey, Randy even shared some insights of what he thought on more the junior market. Now to shift our focus, still within the precious metals and resource sector, but a little bit more towards the smaller junior companies. I am chatting with Matt Geiger, managing partner at MJG Capital. We have Matt on the show pretty much every month to talk about what he's doing within his fund at MJG and how he views the market, what sort of transactions he's looking for within his fund. Matt, it's the end of the year, so what I want to do is take a quick look back in 2024 on some of your best investments, maybe even some of the underperforming ones and some of the key picture themes for 2024, and then transition into 2025. So first things first, let's learn from some of your best and let's say not so good investments from 2024. Matt, break down some of the best investments that you had just this year within the fund at MJG Capital, please.
Sure thing, and good to be joining you again, Corey, for last show of the year here. In terms of the names that I've written about and discussed publicly, kind of two names come to mind. The first big winner would be Lara Exploration, ticker LRA on the TSXV. That's up roughly 175% year to date and has really carried a lot of water for the MJG portfolio over the course of the year. I would argue the share price move comes down to two main factors for Lara. The first is on the people front, and it was the appointment of Simon Ingram to the CEO role in January, with Lara's longtime CEO Miles Thompson stepping to the executive chairman role. This definitely breathed life into the Lara story. And Simon and Miles have a working relationship that goes back many years. Listeners of your show that remember Reservoir Minerals will remember those two as the leading figures there. And they were behind what was potentially the best discovery of the 2010s, and that was the Čukaru Peki copper gold porphyry discovery in Serbia, which ultimately sold to Nebsun for $450 million. So it was a big win in what was a tough market at the time. That of course has since changed ownerships again to Zijin and is now in production. And Zijin's actually done a tremendous job bringing that asset online quickly and efficiently. And it's a major mine for them at the moment. So Simon and Miles have a fruitful history working together. And Simon had actually taken a sabbatical post Reservoir days. So this is his first deal post the Reservoir success, and he's really thrown himself into the role. And I think the share price has reacted as a result. And then I said the second driver on the Lara front has been developments at its flagship Planalto project, which I was able to visit back in mid-2023. This is in Brazil's Carajás mining district, so right in the heart of the Brazil mining scene. This is where Vale grew up and became the major company that it is today. I will say that Lara received a huge streak of fortune. This was in late 2023 when the keys to Planalto were handed back to the company by their former JV partner, Planalto, who was focused more on their later stage projects in Chile, and had spent $10 million of their own money on Planalto, only to hand the keys back to Lara when copper was closer to 360 or 370 per pound. And then in addition to that, Lara has come out more recently with a maiden resource at Planalto, which I think really surprised, at least judging by the share price reaction, really surprised the market to the upside in terms of the size there, at over 200 million tons of open pitable resources there. So this is not a tier one deposit in terms of scale, but Planalto's advantages in terms of location, near hungry mills and near existing infrastructure, its permittability, metallurgy. There's a real lot going for this project, and I think it's going to make it into production much faster than many anticipate. So I'm expecting Lara to ultimately sell Planalto. I don't think they'll take this into production. We could see a transaction within the next 12 or 18 months, and I wouldn't be surprised for the price to be well in excess of Lara's current market capitalization. And then, of course, there's a whole lot more to the Lara story with assets in Brazil and Peru. And Miles Thompson's primarily taking the lead on Lara, the rest of the Lara portfolio, with Simon driving forward things at Plan Alto. So I think the company is really well situated as we head into 2025.
What do you think of those other projects in South America then? Because look, Lara is a prospect gener royalty company. One project is, I believe, back in production. Another project was sold this year. What do you like in terms of the rest of that portfolio outside of Plan Alto?
Yeah, well, there's a lot in there, and it's a true sum of the parts story. I would argue there's two other assets that are worth paying attention to. One of them is an asset called Liberdade, which is a copper IOCG deposit also in Brazil. I would argue it's geologically more prospective than Plan Alto even. The issue there is that it's been caught up in litigation for years. We're getting on close to a decade now of litigation between who was Lara's partner at the project and then Vale. So a resolution there, and it's very difficult to handicap. There will be an end to this litigation at some point here, and that would put a shock into the Lara share price overnight when that occurs. So that's one asset that, one could argue at Lara's, 60, 70 odd million market capitalization could be a company maker right there, when it's freed from the shackles of the ongoing legal battle. The second is a phosphate asset in Peru, which in the previous market cycle received a $50 million valuation when it was part of Stonegate Agricom. So Lara's quietly working behind the scenes there, getting local communities on side, and really, I think, situating that for either a sale, a partner to come in, or maybe even potentially a spin out. So I would say amongst the rest of the Lara portfolio, those are the two other assets to pay particular attention to, but there's a lot more going on within the portfolio.
Okay. Yeah, I always find it encouraging too when share prices moving higher are driven by actual news events, and that resource from Plan Alto, in a way, kind of re-rated the stock. But hey, there's a lot more going on there. What's that other investment you're going to share with us from this year?
Oh yeah, it's a name that you know quite well. It's Kenorland Minerals, and that's one that we've written about in recent investor letters. I know the CEO, Zach Flood, there comes on the KE report quite often, and he does an excellent job really sharing the Kenorland story with the market and keeping investors abreast on the company's progress there. I'd argue the driver for KLD's performance this year, stems from that fantastic deal announced all the way back in January, where they swapped their 20% project level stake in the Frotet project, which I was also able to visit last year. That was in the fall of last year. Swapped that with the majority owner there, Sumitomo, where Sumi assumed 100% ownership, and Kenorland received a 4%, a really healthy 4% NSR on the project, with a limited buy down to 3.25%. So I think the re-rate we've seen this year has been the market really slowly understanding that the value of the Frotet royalty alone really dwarfed Kenorland's enterprise value, with the rest of the company's operations coming for free. And even at the company's more elevated share price today, whether we're at somewhere between $1.15 and $1.20 per share, simple back of the envelope math, just looking at the amount of money that Sumitomo needs to buy down that 0.75% royalty, and then applying that to the residual 3.25%, the residual value almost perfectly covers Kenorland's current enterprise value. Once you factor in it's 27 million in working capital, and then 3 or 4 odd million in marketable securities. So I'm still very optimistic on the future of Kenorland, with at least 4 of their projects, Frotet, Shabistawan, Hunter, and South Uchi as well, set to be drilled by partners next year. I think you can make a very good argument that cash, marketable securities, and the Frotet royalty aside, all else comes for free.
What do you think of the strategy, too, that Kenorland has undertaken where they're creating royalties on some of these early on stages? This is a prospect generator, but they're already getting on that trend of creating a royalty, keeping it in a subsidiary, and still looking for partners.
Yeah, I think it's smart. I would still classify Kenorland as a prospect generator, but I would say within the prospect generator business model, there are kind of 2 trains of thought. I think Kenorland are going about it the right way. One train of thought is to keep a project level interest, and the other is to prioritize a royalty. So Kenorland is taking more of the EMX route, so to speak, where they care less about the project level interest and are prioritizing the royalty over all else. And I think that makes sense because the royalty is a financial instrument, within the metals and mining space. It seemingly gains attractiveness every single year, and that's been a phenomenon that we've seen play out over the past couple decades.
Okay, so a couple prospect generators transitioning to royalty companies that did well this year that you're invested in. What about some of the underperforming investments or investment that didn't work out for the fund, at least this year?
Sure. Well, a name I've written about publicly that has not gone our way this year, quite admittedly, is Bravo Mining. Bravo remains one of our larger holdings within the portfolio, and it's a name that we were fortunate enough to invest pre-IPO stage. So it has been a large winner for us since our initial investment back in 2022, but it's been a really rough year for the company. I will say I've been surprised by the extent of the share price weakness. We have talked about Bravo on previous discussions on the KE report, and you'll remember spring of this year, I think it was late May, the company announced out of the blue that they had made a new discovery at their T5 target, hitting 11 meters of 15% copper equivalent mineralization of IOCG mineralization. First time that IOCG mineralization had ever been encountered on the company's land package there at Luanga. And in short order, that saw the company's share price re-rate from 223 share price all the way up to close to 450 per share on the back of that stunning result, which really came out of the blue. With that said, in the ensuing months, it's become clear that the T5 target itself does not have sufficient tonnage to really justify a standalone operation, or if it is standalone, it's not large enough to get the market too exciting. But the reality is we've seen the share price retreat all the way from north of $4, well below $2 per share at this point. And so if you look back, again, Bravo was trading at 223 upon the announcement of that IOCG discovery. So I think one could argue that you're receiving zero value at this point for any IOCG mineralization on the entire land package. And I think that's ultimately a mistake. 11 meters of that grade of copper equivalent does not come out of nowhere. And so, it hasn't come together as quickly as the market would have liked, clearly. But I think this team has, the resources with over 20 million in the bank and a very accomplished technical team with previous IOCG experience in the Carajás district itself to really flesh this out and figure out where the source of that mineralization is. So for the time being, Bravo is in the penalty box. And I think the market's looking for them to kind of solve this IOCG puzzle before the story is reignited again. So it's a bit of a waiting game there. But again, the saving grace is they have, really healthy working capital position that's going to allow them to flesh out this thesis as we go into 2025. But undoubtedly, that position has weighed heavily on the portfolio, over the course of this year, down close to 35 or 40% year to date.
So, Matt, would your strategy here be to cost average down in Bravo, or are you simply still in this kind of wait and see period, all taking into consideration that it does sound like they need to do a lot more work here?
Yes, fair question. Given the existing size of the position, we're in the wait and see mode. I mean, Bravo is close a double digit, weighting within the portfolio as is. If it was a smaller weighting within the portfolio, kind of, 5% or less, we'd certainly be looking to double down at its current juncture. And again, I really need to emphasize the significance of its working capital position. If I knew the company needed to raise money in the foreseeable future, then the game plan would be to sit on our hands and, wait to participate in the financing. But they did such a good job of raising large sums of capital when the market was cooperating in 2023 in particular, that they've set themselves up. Even though expiration hasn't gone as quickly as folks would have liked, they set themselves up for over a year of runway and significant work before they'd even need to consider coming back to market for more capital.
Let's stick to that financing point just a little bit more, tie that into 2024 and also M&A, because look, we did see a lot of money raised in the sector. However, the argument being that it went into generally a fewer number of companies. And also M&A. Man, there was a lot of mergers and acquisitions this year, really focused on the higher quality, more developed assets, even those already in production. But we did also start to see some mergers between some of the smaller junior companies. These two themes of 2024, what do they mean to you?
Yeah, well, we've discussed ad nauseum in recent podcasts, just the M&A mania that we have seen really over the past 4 to 5 months. And I think the last time that we had a discussion, I highlighted 5 different deals where between them, we're talking 22 or $23 billion worth of value changing hands there. So this is substantial and, the most M&A that we've seen in probably over a decade. And I would say the pace of that M&A has, simply continued since our last discussion. I mean, here we are in mid-December. Just this month, right at the beginning of December, we had Northern Star all-share offer for De Grey Mining in Australia for its, tier 1 Hemi gold project in WA for Aussie 5 billion. So that is very chunky. That adds to our total and gets us closer to 30 billion just between 6 different deals there. That was a nice 37% premium being paid by Northern Star, acquisition to close, likely in the spring of next year. So that's a very notable deal that maybe some in the North American markets missed. We've also had Newmont continue with its non-core asset disposal process, and we've seen Cripple Creek sold this month to SSR Mining. That's only $100 million upfront, but the total price tag there could rise up to $275 million US, pending various regulatory approvals. And that's fast on the heels of Newmont also monetizing its Eleanor mine in Quebec, for roughly $800 million in cash. That was in late November. And then in mid-November, they sold Musselwhite for a similar sum. I think that was roughly $850 million. That was to Orla Mining. So fortunately for the sector, Newmont is nearly through its asset disposal process. I know coffee may still be on the chopping block and maybe there are 1 or 2 other assets, but their process is largely complete by this point. And then just this week, we had Lundin's sale of its Neves Corvo and Zinkgruvan mines, both in Europe, to Boliden. That's $1.5 billion. So that's not a deal to sneeze at by any means. This positions Lundin much more as a copper-focused and South American-focused operator. Hopefully it's a win for both projects. Those are both pretty decent assets, make a lot of sense for Boliden, both from a commodity and a jurisdictional perspective. So hopefully a win for both groups there. And then very recently we had Agnico Eagle finally make a move for O3 Mining. This was a deal that was many years in the works, and I think Agnico found an opportunistic time to pounce. That's a smaller deal at maybe 200 million, give or take, taking O3 off the board. So really the M&A activity that we've discussed just continues apace. And I think it's a really interesting question to see if it continues into the new year. My anticipation is it does.
Yeah, I'm with you. I feel like this M&A is going to continue, but who knows? These are the kind of things that can turn on a dime. However, that environment still looks very promising for, again, the higher quality companies, projects, and also the ones that make sense beside other major mines or major assets. Let's move to 2025. Key themes in 2025. What is on your radar early on, Matt?
Well, in no particular order, and I would say these are more unanswered questions than anything. But these questions that are playing on my mind, one is on the precious metals front. 2024 was very much a story of central bank buying and investment demands, ex the Western world. So the question is, come 2025, do Western institutional and even retail investors, warm to the precious metal story? So that remains to be seen. My inclination is probably not yet. That might be more of a 2026 story. And I think precious metals have come so far in such a short period of time, that wouldn't be a bad thing to see some consolidation. And, I think when the Western world does warm to precious metals en masse, that will supply the next up leg within the bull market. But that's one open question. The second, in previous years, in recent memory, where we've seen precious metals really rip, you can think back to 2016, you can think back to 2020. I'd say 2024 is a similar year in that respect. The following year, we've seen spillover into the broader metals complex. So, the open question here is, does this repeat? Where in 2025, it's more of a year that's favorable to metals like copper and other industrial metals, or maybe even some life returns to the battery materials and energy metals like lithium and nickel. My gut says this is quite possible that history will repeat, but the jury's still very much out on this front. Another question that comes to mind, and we just touched on this, is does the M&A boom that we've seen over the past 4 to 5 months, continue unabated into the new year? My inclination is yes, but that also remains to be seen. And on a related note, and this is of particular interest to the MJG partnership, do we finally see some consolidation within the junior royalty space, which is quite crowded, with sub 500 million market cap names, EMX, Gold Royalty, Elemental, Metalla, Vox, these names come to mind. Personally, I do think we do see some M&A activity, at least a deal, if not a couple amongst this peer group of companies. Though to be fair, I've been saying that this would be the case for 6 to 9 months, and it's been cricket so far. So that's another open question for the new year. And then I would just say from a broader market perspective, can we have an orderly rotation, out of cryptocurrencies, out of high-flying tech companies like the NVIDIAs and the Palantirs of the world, and really out of the overpriced, U.S. market more generally, into underloved spaces like natural resources, like cyclicals more generally, like stock markets ex the United States, or does this rotation have to be precipitated by a crisis? Recent history will say it usually is precipitated by a crisis. So that's probably the direction that I would lean. But again, this is another open question. These are all things that are playing on my mind as we head into the new year.
I think all great questions and all big picture themes for this sector that could really dictate if this bull market continues or if it does start to roll over. But also that money spill over into some of the other metals. So much seems to have gotten concentrated into especially gold and gold stocks this year. Matt, what about jurisdictions? So look, these are always variable, especially in South America, but also around the world. Some jurisdictions get hot, sometimes for multiple years, sometimes just for 1 or 2 years. What jurisdictions right now are you a little bit more cautious on that the market seems to really like?
That is a good question. Okay, so one that comes to mind, and this might upset some listeners, but it's the Ivory Coast, which is, I would argue, the hottest mining jurisdiction in Africa at the moment. I mean, you have groups there like Montage Gold or Awale, both listed on the TSXV. And on the ASX, names like, WIA Gold, Turaco, African Gold. These are stocks that are up, 2 to 3x, if not more, year to date. So some incredible performance. And there's been a lot of money flowing into the Ivory Coast, a lot of drilling activity. Like it truly is a hot and happening jurisdiction at the moment. And for good reason. Incredible geological endowment. And it's a stable and accessible place to explore at the moment. So it's exciting to see. My concern, and I think the question is whether it can remain immune really to the extreme political instability and the jihadi violence that we're seeing to the north in the African Sahel. And we're also seeing that spill into some other parts of West Africa, though not the Ivory Coast at the moment. I mean, heck, since 2020, in the general region, we've seen 9 successful coups. And my understanding is we've seen at least as many unsuccessful coups over that same period. We've seen jihadi violence increase by 140%, according to recent figures since 2020, and millions of people displaced as a result. So, can the Ivory Coast continue to defy gravity and really avoid a lot of these issues that are plaguing its neighbors? I think that's a key question. I'm hopeful that the Ivory Coast can resist these forces, both for the sake of its people, as well as the MJG having some portfolio exposure to the country as it stands. But I think it's something that investors and companies operating in the country should be, paying attention to see if this continues. So that's one area of potential concern. I'd say a second jurisdiction, and I definitely wouldn't describe it as a high-flying jurisdiction like the Ivory Coast. But another jurisdiction I'd flag is Peru. The current president there, Dina Boluarte, she's a stand-in for former President Pedro Castillo, who you remember was thrown in jail in late 2022 for attempting what has been described as an auto coup basically trying to usurp power from the legislature there. She's a stand-in, immensely unpopular. She has a 4% approval rating. Like, I don't think I've seen anything like it. Literally a 4% approval rating. Less than 1 in 20 people approve of her performance in office. And meanwhile, the Peruvian Congress there really is blatantly and transparently corrupt. And their approval rating, according to recent figures, is not much higher than Boularte's herself. So in Peru, we're still a good ways off from the next election. My understanding is it's scheduled for spring of 2026. So we'll say we're roughly 15 months away. But the concern that I'd have is whether the citizenry there is just so fed up with the status quo and may vote for a burn the house down candidate who's not friendly to Western mining interests. So it's hard to say at this point which candidates will emerge as the front runners. I think we'll have a better sense probably towards the middle of 2025, which candidates start getting some traction and the degree to which foreign investors, should be concerned. So we also have some exposure to Peru through the aforementioned Lara expiration. So this is also a situation that I'll be following closely as we head into the new year.
All right, Matt, final question then. As we talked about the potential rotation of some money from precious metals into other metals, what metals do you like that are maybe a little bit more under the radar or haven't performed as well in 2024, now looking into 2025?
Now you're putting me on the spot, Corey, and
Bet.
and you know that when I evaluate new investments, I really do try to de-emphasize the metal of focus and look much more at bottom-up fundamentals, whether it's the people involved, the asset, assuming spot metal prices, the company structure, upcoming catalyst, yada, yada. With that said, one metal that, has piqued my interest for a few years here, and frankly, we've never had exposure to, is the metal tin. There are very few investable vehicles that are out there. And I would love to come across a tin vehicle with the right people behind it, a good looking asset in an investable jurisdiction, and back a company focused on tin from an earlier stage. I've been looking for a few years and haven't come across the right opportunities, so we remain tinless within the MJG portfolio. Perhaps I should just bite the bullet and buy Alphamin, which is an exceptional deposit, the Bissi deposit, located in a very unsavory part of a tricky jurisdiction, which is the DRC. So that's another, viable avenue for tin exposure. But I do think tin is interesting given its irreplaceable role in semiconductors. And I've been a bit surprised we haven't seen more of a grasping of tin's role in kind of the AI revolution and the continued push there, and more generalists, stream into the tin space. I think that is something that we could see in 2025 or 2026. So the metal does seem potentially meme-worthy for me and has received, a good amount of attention. I'd say an outsized amount of attention within the mining investment community. But I've yet to kind of see that spill over to generalists more broadly. So that's one metal I'd flag as we head into the new year.
All right, Matt, great having you on the show. It's been an absolute pleasure and honor to chat with you on pretty much a monthly basis, and I really appreciate how you have broken down some of the investments that you have within the MJG portfolio and just how you're viewing these markets. This weekend show, I think, has been a very unique one, hearing from one of the largest company executives in the resource sector, as well as an active fund manager in the resource sector. Please, everyone, take note of what these guys are saying and what they are looking forward to in 2025. Again, Matt Geiger, managing partner at MJG Capital. Matt, thanks for joining us on this weekend show, and everyone, thanks for tuning in. I hope you all have a very happy holiday season, a Merry Christmas to everybody. Next week, we will be a bit shorter with the daily editorials, but be sure to check the website and podcast for a few more company and market updates. Matt, everybody, again, thanks for tuning in. Have a great rest of your weekend.
The Kenorland Economics Report is produced for A.B. Kenorland and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Kenorland, This is Colleen Robbins. Join us again next week for the Kenorland Economics Report.